Good morning. We're just going to give it another 30 seconds. Zoom is letting people in. It's just taking a few minutes here. We'll kick off. All right. Good morning. Welcome to the SevenBridge May Webinar. I'm Justin Ferraccio. There's a few people on the call that may not know me, so I'll quickly introduce myself. Been in finance for about 18 years now. I joined SevenBridge almost 6 years ago, and I'm a partner here at the firm. And this is Chuck Everly.
Hey, good morning, everybody. Glad you're here.
On the call, you also see Evan, who we'll get to momentarily. Good morning, Evan.
Good morning.
So I'm going to share my screen and we'll get kicked off. All right, so just a quick reminder, since there's some new faces on the call, the purpose of this meeting is just meant to be kind of a monthly update on our current thoughts on the market, economic factors. Sometimes we'll bring in guest speakers. We'll talk about taxes. We'll talk about estate planning, all kind of different areas just to help out and add value. This is just meant to be kind of an added benefit to being a client or a prospect or a friend of the firm, any of those things. It's not meant to be a replacement for your meetings with us directly. So if you have a question on your account that pertains to your specific situation, reach out to Chuck or myself. Some of you may know Evan as well. So today we're going to talk about market performance, kind of what's been happening year to date. We're going to talk about the market influences slide, which we've updated. And then we'll talk about, specific areas that we think are valuable to focus on now. So I think one thing that's interesting is things are changing quickly. It's a very dynamic market right now. We had the webinar done Friday, finished this weekend, kind of ready to go. And we had to rewrite the whole thing yesterday just because so many things changed over the weekend. It's just that data becomes stale very quickly. So we'll get into that as well. But let's first introduce Evan. So Evan is a senior advisor at the firm. He just joined about a month ago. So Chuck and I have been kind of on the hunt for another advisor for about 6 months. We hired a recruiting firm. We had many, many interviews, and we were just having trouble finding the right person that aligned with our core values, had the right experience. Evan actually came to us through another employee at the firm, Portia Savage, who's known Evan for most of his career. She suggested Chuck and I talk to him, and everything just worked out great, and he's a perfect fit. So we're excited to have him here. So Evan, why don't you introduce yourself quickly?
Yeah, perfect. So thank you for sharing a little bit about me. So I'm excited to be a part of the firm. Been in the industry going on 10 years now. Came right out of college, so I have an economics degree. Started as a paraplanner for a private firm and then worked my way to being an advisor. So I've been an advisor now going on 4 or 5 years. Really leveraging my skill set is in the financial planning department. So I've spent many years just building plans for all of our clients at my old firm. Clients range from small to large, all across the board, different unique niches and situations. So really looking forward to bringing that experience to the table to help Justin and Chuck with everybody's needs, as well as I am boots on the ground here in Harrisburg. So anybody that's in this area, feel free, if you have questions or something you want to reach out, I'm more than happy to help answer those questions for you. And then in my free time, I really just like to golf and spend time with my family. I have a dog. We like to hike with my fiance, and we're getting married this year. So busy year for me in personal and work life. But really looking forward to getting to know everybody. And again, if you have any questions or you want to reach out just to, pick my brain or get to know me as a person, my phone's always there. My door's always open.
Yeah, I think one thing that's important when you, each person at the firm's going to have a primary, advisor that you can reach out to. But the other important thing is we want every client to know all three of us, because in reality, we're all three here to help each client of the firm. So if one of us are out of the office, you'll know that there's someone else you can talk to, and we're all on the same page as far as investment strategy, financial planning advice. I think if you pick up the phone and call me and ask a question and then hang up and call Evan or Justin and ask a question, you're not gonna get the same answer. So we are all on the same page. We are also all here to help you, as a team.
Yeah. And then, as Evan said, he'll be boots on the ground in Harrisburg full time. Just a reminder, Chuck and I, we're alternating months, but one of us is back in Harrisburg 1 week every month. So we're both back 6 times a year. So there'll be plenty of time for in-person meetings for our East Coast clients too.
Yep.
So year-to-date performance in the market. Again, things have changed drastically since the last time we showed this slide. Markets are creeping back to, relatively flat for the year. Dow and S&P are very close. NASDAQ is still down about 3% as of this morning. Just a reminder, NASDAQ is the more, tech-focused stocks that were hit hardest this year. Russell is small and mid caps. That's still recovering, but not as quickly. And then equal weight is actually positive for the year now. Bond market has kind of stayed where it's been for the last month or two. It's relatively flat. It's up just a hair, and we'll get into kind of our thoughts on where that's trending here deeper into the presentation.
Okay, so here's a slide that we tend to go over. What's the current situation? What if things get better? What if they get worse? So main things that are on the table right now: tariff policy, economic growth, or really that's a fear of a recession is that column, and then inflation. So tariff policy, that's a moving target hour by hour. Like Justin said, we had this presentation all done on Friday and ready to go, and everything changed over the weekend. I think that's one thing to expect. We're just one news story away from things changing. But current situation is, the fear of tariffs wasn't as bad as what the markets, a month ago saw or reacted to. We think there was an overreaction there, and we see this big snapback. So things get better if, agreements are made and, we're, around a 10% tariff, but we don't know. Last month we talked about, you start to boil down the tariff issue and the size that as it relates to total GDP. It was about 10% of GDP, goods and services, that were impacted. And that really didn't rise to the occasion to cause a recession. Things get worse if, talks break down, those tariffs end up being higher, and those will definitely have an impact on the market. Economic growth, current situation is, more towards a soft landing or no landing, which that's what we're seeing right now. There's no data that's showing a recession's on the way. Doesn't mean it can't happen, but right now there's no data to support it. So that's something that we're watching, the same things that we talk about each month as far as, the surveys with services and manufacturing, earnings, all these things are what we're watching to see, are we heading towards a slowdown or not? Inflation, numbers were just released this morning. That's part of the reason the market's up. Market was expecting 2.4%. We came at 2.3, which is as low as it's been since 2021. So another indication that, things are getting better on the inflation front. And we'll talk about what the Fed sees here later in the presentation.
Great. So, today we thought we'd just talk about some areas that are important to focus on now, right? So over the weekend, the United States and China came to terms on a 90-day lowering of tariffs. I'm sure you all saw this yesterday, but it caused an immediate and meaningful increase in stocks. I think, the important thing to remember here is this is it's a 90-day agreement. It's a 90-day pause. The deal is not finalized. The deal is still being negotiated. We expect to continue to see volatility here. So I think that's one thing that Chuck and I will go over a little bit further. We're not out of the woods. This isn't green light, everything's great moving forward. This is the market, kind of what we talked about last few webinars. You know, when things are tough, our strategy is meant to kind of, reduce the impact that you're going to feel. And we need to hold on through tough times. And, we kind of hinted before that we thought the market was overreacting. We expected some sort of deal to get done with China within the next 3-4 months. Something has happened sooner than expected. But it doesn't mean this is the end of the volatility.
Yeah, it definitely feels better today than it did a month ago when we were doing the last webinar. We were right in the middle of kind of the shock of the tariffs being much more than expected. The markets reacted, and we feel overreacted. So basically, we're not, where that decline happened, that steep drop, we've recovered from that. And it's kind of, you think back to what we talked about last month, we talked about you're driving your car, you hit a patch of ice, it's important not to panic, take a deep breath, don't slam on the brakes, don't hit the accelerator. And, that ended up being true, but it also, I think things recovered much more quickly than what we expected. So we kind of have an opportunity, when, it's a good time to look at concentrated stocks, positions that you have, concentrations in sectors, and reevaluate how you felt that Thursday and Friday when, the market dropped 12% 2 days. How did you feel? That's how you evaluate your true risk tolerance. You don't evaluate risk tolerance when things just go up all the time. You evaluate it whenever things aren't cooperating. And then it's also a good time to look at your time horizon for your money. Are you pulling an income out? Are you looking to pull an income soon? How much, do you have in more volatile stocks? Do you have concentration there? Those are things to think about now because we have an opportunity to adjust those things when they're not compressed. The values, are back up, not completely up. NVIDIA is a stock that many of you hold. That's up 37% from the bottom. Apple's up 23, Microsoft 27. So we didn't want to fix the concentration whenever things were compressed, but now's the time to look at that, and we'll be reaching out to many of you.
Yeah. And just to piggyback off that, it's, we've had conversations with many of you, and we've made tweaks throughout the year, but it's, for example, if we bought NVIDIA and it was 3% of your portfolio 2 or 3 years ago, and it's crept up to 7, 8, 9%, we've had those conversations, and it's hard when things are going straight up to, we call you and say, we need to trim this position back, but there's tax consequences. It's, that conversation is never fun. People don't want to pay taxes, capital gains taxes when things have gone well. But this is just, a good example and point in time to a reference point that we can pin and look at where it's, that position's done well. It's now 8% of your portfolio, but whenever it's down 30, 40%, you can really feel the impact of that. So our job is to kind of continue to work through that with you, trim that position. It wasn't the right time to trim the position when it was down 30, 40%, but now that it's recovered kind of back to close to where it was before, not completely back, it's another good point in time where we can look at it and say, what's the better position to be in, pay some taxes or continue to keep more risk on the table than we want. Last thing we want to go through here is volatility protection, no matter what the scenario. And that's just a reminder, which we've talked about this probably more than you want to hear, but our portfolios are designed to lose less when things are tough. Most of you felt probably about 50% of the downside when the market was down, 10, 12, 15%, you were down about half of that, right? And that, again, is because most people at the firm have those position sizes correct, where it's, your portfolio is 3% Apple, 3% Nvidia, 3% Microsoft. Those are the things that got hit hardest. And we focus really, really hard on sector allocation. So how many, like what percent we want in each different sector of the economy, how much we want in healthcare, technology, financial services, and not letting any of those sectors get overweight, try to design to be as bulletproof as possible.
Yeah, I think, we continue to do reviews, during the last month. So a lot of people I talked to, they didn't want to look at, see how far they were impacted. Or they had an idea, but they weren't quite sure. But most people I talked to thought, I asked them, what do you think you're down? They were thinking, 20% or 25. And most of those clients were down 3% or down 4%. So, the volatility protection, we focus on risk mitigation with each of you. We want to participate when things are moving higher. We definitely want that, but we definitely want to protect on the downside. And the portfolio's done that through the financial crisis, COVID, 2022, and now the tariff situation. So it does work. But like Justin was talking about, we have to look at concentration in sectors, individual stocks, and we have to have that conversation about trimming that. And it's going to cost some taxes, but we'd rather have you pay taxes than take an excessive loss. Because really what you're talking about is, when you're going through a tough period, that's when you open yourself up. If you have too much concentration, it shows up and, maybe making a bad decision, to say, you're happy with the concentration when things are moving up. When they work against you, a lot of times people want to make that change then when it's the wrong time. The right time is when you do have the profit and you can take advantage of it, redeploy it in things that are cheaper. And you can make that tax up that way. If you hold the concentration and that thing goes down, you could not have a tax problem because you don't have the gain anymore, which that's worse than paying the tax.
And, Chuck also hinted at this, but, we get this question a lot is, what are we doing now in this market to protect volatility and protect downside risk? And it's, we almost never know what's going to happen ahead of time, right? We didn't know the great financial crisis was around the corner. We didn't, know that COVID was around the corner. We didn't know 2022 is going to be the way it was. So it's just important to remember that we're building these portfolios to protect in any downside risk scenario. It's not specific to what happens with tariffs. This could have just as easily been, a financial breakdown, and we would have had similar results, right? So we're building these to protect in any scenario. It's not a specific scenario because we don't know what the scenario is going to be ahead of time. So from there, we're going to go to questions. A reminder, you can send questions directly into the chat. They come to us. No one sees your questions except for me and Chuck. We've already gotten a few submitted, so we'll start with those. And if any more trickle in, we'll answer as many as we can. So let's see. The first one here is, do we think there's going to be a recession? What's SevenBridge thoughts on that currently?
Yeah, right now we don't. There's no indication that a recession's on the way. It's always possible. Things can change, and they will. They will change. But what we're looking at is, the data. So, we don't watch the nightly news to figure out whether a recession's coming. We look at data. So none of the data right now is suggesting a recession. Any data point, employment, inflation, earnings, the surveys with services and manufacturing are not showing a contraction or one comment, but all that can change right now. We don't expect it.
Okay, next question. what do we think about interest rates through the rest of this year? So we've spent a lot of time thinking about this and reading about it. And again, it's a moving target. You know, if you'd have asked us this question in December, we'd have told you we'd expect 3 to 4 rate cuts this year, starting in Q1, right? As of right now, we are expecting a rate cut, but not until July. And after that, our best guess is we'll get 1 to 2 more this year. But, you know, again, kind of ever changing, but we do expect to see a 0.5 point this year would be our best guess at the moment.
Yeah.
And the market agrees with us. You know, there's 75% likelihood of a rate cut in July as of right now, but those are the same people that were wrong about a rate cut in March. So let's see.
Yeah, the data we look at for rate cuts is they do a survey of the Fed governors, and you know, they all put their opinions in there, and that's, you know, the majorities, you know, in that July timeframe for a 1/4 point cut. But I think one thing to keep in mind is, you know, the Federal Reserve controls short-term interest rates through, you know, the Fed rate. So that's what we're talking about. Interest rates, you know, the bond market's 3 times larger than the stock market. It's considered to be smarter than the stock market, less emotional. But when you look at the 10 years, what we're watching, primarily, because that controls or indicates mortgage rates, corporate lending rates. The Fed does have an influence on that, but when they, you know, quantitative tightening and quantitative easing, you know, it's basically them selling or buying their balance sheet. So they do have an impact on that. But we saw a rise in the 10-year. You know, many people think that that's because of China and other governments selling our bonds. There's been no confirmation of that, but that could be a possibility. The 10 years sitting around 4.4 right now, which, you know, historically that's pretty average, but we're kind of used to 0. And when it's not 0, it feels like it's a lot, but it really isn't. We're back to more normal, but we don't expect those rates to go back to 0. It kind of will be in a range.
Yeah. Next question. It's a good one. Should we be putting money into the market now or sitting on cash? Right. And I think this one is more case by case. I think this is one that is important to have your a discussion with your advisor. But I'll give you my kind of general opinions on this, and I'll let Chuck do the same. As the markets have run up a lot over the last month, right? But the way that I think about it is, even, you know, Chuck and I pay ourselves monthly. Every month I'm putting money into the stock market. I think that there's a lot of value out there still. You know, you can find companies like NVIDIA, Broadcom, Apple, Microsoft that are still down 10, 20% on the year, right? And they're great companies. And I look at it as, could NVIDIA go down 10% more this year? It certainly could, right? But could it go up 10%? It could as well. But you know, what do I think NVIDIA is going to be in 3 years, 5 years, 10 years? I think it's going to be a lot higher than it is today. And I love the fact that I can get it at what I perceive as a 20% discount, right? So, you know, if you're asking, should we put, you know, $2 million in the market today? No, I don't think so, right? I think that, you know, if someone came to us with a large sum of cash right now, our advice would be, let's get some to work now. Let's watch things. Let's kind of get it in over time. See if we get another big downdraft where we can get more to work quickly. But it would be more working money into the market at a controlled pace. Now, if it was $50,000 in $1 million account, I think it would be appropriate to get that money to work, you know, this week, right? So it's more case by case. But I just look at, we're investors, we're not traders. I can't predict what's going to happen in the next 6 months or year, but we can pretty accurately forecast what we think is going to happen in the next 5 years, 10 years, 20 years, 30 years, depending on your time horizon. And, you know, we think that the markets will be in a much better spot, you know, in the future. So you have thoughts there?
Yeah, I think it's, you know, time horizon is probably the most important. What's your time horizon? You know, typically when new money comes in, what we're looking to do is, where is somebody, where do you have, you need more exposure? New money coming in and your light and utilities, your light and energy, we want to add that money, right away. There's no reason to time it. And we don't look at it as right now, everything's all fixed and, pile in a bunch of new money because it's all better. It's not all better. We're in the middle of it. We have a reprieve right now, and a chance to look at things and allocate. But I don't look at it as the buying opportunity of the century right now. But I think it's okay to add the places that you need to add exposure. And that's the way we would look at adding money if you have money on the sideline right now.
One more question. What are our thoughts on capital gains tax? It's kind of a pretty broad question. So, it stinks. Paying taxes stinks always, right? But I think when it's appropriate, I think it's important, right? So, again, if a position size is run too far, I would much rather, on my personal account, my clients' accounts, I'd much rather pay tax in that position, get it right sized, redeploy money into other companies or other sectors that we perceive as valuable or undervalued at the moment. And so it's kind of a necessary evil. No one ever likes paying taxes. No one wants to pay more taxes than you have to pay. But unless you're planning to, never spend that money and just pass it to your kids when you pass away in 20, 30, 50, 60 years, at some point you have to pay the tax, right? You can't let that position size get away from you forever. And so I look at it as a necessary evil we have to deal with from time to time, and it's just not fun.
Yeah, I think to add to that, if the way we manage money, we're buying individual stocks. If you own mutual funds, they're kicking out capital gains every year, and you have no control over it. So you own a fund, it's automatically happening to you. And many times, especially during volatile times, there'll be a lot of capital gains distributed. So you look at your taxable portfolio, if you're paying on average about 5% of that value in capital gains, that's okay. You almost have to do that. And what we will be doing is, like we did last year, we'll capture losses when we can, minimize the gains that you have. So it's okay to, trim an excessive position, have a realized gain on that, and then we'll look to reduce that as the year goes on. We'll also, for many of you, book realized losses that we can use as carry forwards and offset that. So it's kind of putting the whole thing together. But don't let the taxes drive your investment strategy. It's a consideration for sure. You don't ignore it, but you don't let it drive it.
Yep. And again, it's one of the advantages of using individual stocks is it does help us control taxes, right? There's always going to be tax losses to harvest. United Health Group is a good example. We think it's a great company. It's had a very difficult year. It's something that we'll probably sell in every taxable account at some point this year, buy something similar for 30 days, and then buy United Health Group back 30 days after that. And what that allows us to do, if you have a $5,000 loss in United Health Group and you have a $5,000 gain in NVIDIA that we want to trim, we can offset those two things, right? So we can be tax efficient even when we're having to take gains. There's always going to be, even in great years, there's sectors of the economy that are down. And so we're always looking to harvest losses and offset taxes and be as tax efficient as possible.
Hey,
that's it.
We're hit the half hour.
That was all the questions, but appreciate it. We got 4 or 5 questions through. Appreciate the engagement and really appreciate you all taking 30 minutes with us, and we'll do it again next month. And I can promise you, I have no idea what we're going to talk about in 30 days. A lot's going to change. We're optimistic. We're looking at the long term, and we see a path through this. So individual questions, reach out to us and we'll address them. But again, appreciate you.
Yep. Glad everybody joined us. Evan, thanks for being part of the team, and you're gonna be taking a much more active role in the next webinar.
Looking forward to it.
All right, thanks.